The natural gas market has been on a bullish run this week, as futures prices surged to their highest levels since 2014. The May NYMEX contract, which became the prompt month on Wednesday, posted a double-digit gain of 27.5 cents and settled at $5.605 per million British thermal units. The June contract also rose by 27.7 cents to $5.658 per million British thermal units. This impressive rally was driven by several factors, including strong demand from power generation and liquefied natural gas, LNG, exports, tight supply due to low production and storage levels, and bullish weather forecasts that indicated colder than normal temperatures for late April and early May. The most notable achievement of the week was the breakthrough of the mid-$2 range that has dominated the trading since March. The May contract closed above $2.50 per million British thermal units on Monday for the first time since February 26, and then soared past $3 per million British thermal units on Tuesday, breaking a key resistance level. On Wednesday, it reached a high of $5.64 per million British thermal units, the highest intraday price since December 2014. The bullish momentum was not limited to the U.S. market, as natural gas prices in Europe and the U.S. also soared by double digits on Wednesday, amid a severe energy crisis that has caused power outages, supply disruptions, and soaring costs for consumers and businesses. A fire at an electricity converter station that connected France to England added to the woes of the region, which is facing a shortage of natural gas due to low storage levels, reduced imports from Russia and Norway, and high demand from Asia. The natural gas futures market has shown remarkable strength and resilience this week, despite some bearish factors such as rising rig counts, weak cash prices, and high volatility. The market has also shrugged off the impact of the coronavirus pandemic, which has reduced industrial and commercial demand for natural gas. The question now is whether the natural gas bulls can sustain this rally in the coming weeks and months, or whether they will face a correction or a reversal as the weather warms up, the supply situation improves, and the demand outlook becomes uncertain. Some analysts believe that the market has reached a seasonal bottom and is poised for further gains, while others warn that the market is overbought and vulnerable to profit-taking. Whatever the outcome, one thing is clear: the natural gas market has been one of the most exciting and profitable markets to watch this week, as it broke past the mid-$2 pricing that has characterized much of the trading since March in America's largest gas market. In this section, I will talk about how new groundbreaking technologies to keep carbon dioxide out of the atmosphere could be the next big breakthrough for the natural gas and oil industry. These technologies are collectively called carbon capture, utilization, and storage, CCUS. CCUS is a process that involves capturing carbon dioxide, CO2, from the emissions of natural gas and oil facilities, and either using it to create products or storing it underground. By doing so, CCUS can reduce the greenhouse gas emissions of the fossil fuel industry and help achieve net zero targets by 2050. One of the main benefits of CCUS is that it can be applied to many hard-to-abate sectors, such as aviation, cement, and hydrogen production from fossil fuels. For example, there is currently no alternative to CCUS for near-zero cement production, which accounts for about 8% of global CO2 emissions. CCUS can also enable the production of low-carbon hydrogen from natural gas, which can be used as a clean fuel for various applications. Another benefit of CCUS is that it can generate revenue streams for the natural gas and oil industry by utilizing the captured CO2 to create products such as fuels, chemicals, and building materials. For instance, CO2 can be used to make synthetic fuels that can power vehicles or planes. CO2 can also be used for enhanced oil and gas recovery, or/EGR, which involves injecting CO2 into depleted reservoirs to increase the output of oil and gas. However, CCUS also faces many challenges and barriers that need to be overcome. One of them is the high cost of capturing CO2 from dilute sources, such as power plants or industrial facilities. The cost of capture can vary depending on the concentration of CO2 in the flue gas, the type of capture technology, and the location and size of the facility. According to the International Energy Agency, IEA, the cost of capture ranges from $15 to $75 per ton of CO2 for natural gas processing plants, but can go up to $120 per ton for coal-fired power plants. Another challenge is the lack of adequate infrastructure and regulation for transporting and storing CO2 safely and securely. Transporting CO2 requires pipelines, ships, rail or trucks that can handle high-pressure CO2. Storing CO2 requires suitable geological formations that can trap CO2 for permanent storage without leakage or contamination. These formations include depleted oil and gas reservoirs or saline aquifers. However, not all regions have access to such formations, and some may face public opposition or legal uncertainties. To overcome these challenges and accelerate the development of CCUS, several actions are needed from governments, industry, and other stakeholders. Some of these actions are providing policy support and incentives for CCUS projects, such as tax credits, subsidies, carbon pricing, or mandates. For example, in the United States, the 45Q tax credit offers up to $85 per ton of CO2 sequestered or $180 per ton of CO2 captured directly from the atmosphere and sequestered. Developing cross-industry hubs that share CCUS infrastructure and resources across multiple facilities. This can reduce the risks and costs associated with individual projects and create economies of scale. For example, in Japan, a showcase project on Hokkaido Island aims to capture CO2 from various sources and use it for OR/EGR or methanol production. Investing in research and innovation to lower the cost and improve the performance of CCUS technologies. This includes developing new capture methods that use less energy or materials, new utilization products that have higher value or demand, and new storage techniques that ensure long-term safety and monitoring. In conclusion, CCUS is a promising technology that can help the natural gas and oil industry reduce its emissions and create new opportunities. However, CCUS also requires significant investment, collaboration, and innovation to overcome its technical and economic challenges. If these challenges are addressed successfully, CCUS could be a game changer for the fossil fuel industry and the climate.